Now, this is CAIIB Risk Management Frequently Asked Questions Part 6. Dear friends, kindly remember this is only a quick recall frequently asked questions for the upcoming exam CAIIB Risk Management. Okay, this is our part 6. Now see here the question number 82. Look at the screen. The first question is, the first step of risk management is dash. The first step of risk management is dash. There are 4 options given. Explore the ways to reduce risk. Then features, that is categorize threats. Third is identify risk. Fourth is assess the vulnerability. Answer is C, identify risk. Then the next question is, a debenture of face value rupees 100 which carries a coupon rate of 15% if the current yield is 12.5%. So what is the price of the debenture? Okay, see debenture, okay, debenture is there. FV, that is the face value is 100 which carries an interest rate, that is the coupon rate is 15%. So if the interest rate is 12.5 instead of 15, so what will be the price? So answer is 120. But see how 120 we received or we got. Current yield, friends, it is the income from investment. Which investment? Both interest and dividend. It is divided, that is the income from investment coming from interest and dividend is divided by the price of the bond. By the price of the bond. So current yield, that is the Y, you can say Y is equal to I divided by P. P is the price of bond. I is the income from investment. In this case, what we will do is the interest came from the investment or interest received earned from the investment is rupees 15. As the coupon is paid on the face value. So the current yield is given as 12.5%, which is stated here itself in the question. So therefore 12.5% is equal to 15. That is the yield. Yield is equal to 12.5% is equal to 15. That is the income earned from investment divided by the price of the bond. So we need to find out the price of bond. That is price of bond will be equal to, we will cross multiply. 15 into 100 divided by 12.5. So the answer will be 120. Answer will be 120. We will upload practical examples of risk management. For the risk management paper, we will be uploading the practical exam, that is the practical exam point of view, practical questions, that is solved questions will be uploaded in the YouTube. Coming back to the next question, moving to the next question, growth fund. What is growth fund? Growth fund is a mutual fund that dash. Growth fund is a mutual fund that assures growth in income or invest in fixed income securities, gives fixed return or invest primarily in equities. Now see here, growth fund. Growth fund means the answer is to invest. Growth fund itself means equity. It indicates only equity, high risk, high return. It indicates only growth fund, indicates only equity. So invest primarily in equity. Growth fund itself, it invests primarily in equity. That's why it's high risk, high return. The growth fund pays little or no dividend. The benefits for the investor comes mainly through the appreciation in the value of the units of the fund. So the investment in fixed income securities offer normal return which are expected to be lesser than those offered by the equity investments, because here risk will be less as compared to the equity investments. Equity investment offers the possibility of higher returns albeit with higher risk. That is also think if higher returns means higher risk. Therefore, growth funds invest in equities. The last question in this slide is, when can an European option be exercised? There are two options, right? American option and European option. So when can an European option be exercised? So there are 4 options at the time of entering into the option contract. Second, at any time during the period of option contract. Third is the only at the maturity of the option contract. Fourth comes the after the expiry of 1 month from the beginning of the contract. So here, see, an European option can be exercised only on the date of expiry of the contract, date of expiry of the contract. So American option contracts can be exercised at any time on or before the expiry of the contract. So if European option they have asked, we should write it can be exercised only on the date of expiry of the contract. This option to be tick mark. C option, that is only at the maturity of the option contract. Only at the maturity of the option contract. Now see here our question number 86, that is the bank shall not invest more than dash % of the unit capital of an REIT, that is nothing but real estate investment trust, and INVIT, that is IT stands for infrastructure investment trust. So how much percent? 10%. 10% is the answer, 10%. So how 10%? See here, banks can invest in real estate investment trust and infrastructure investment trust within the overall ceiling of 20% of their net worth, which is permitted for direct investment in shares, then convertible bonds, debentures, units of equity oriented mutual funds and exposures to venture capital funds, both registered venture fund and non-registered or unregistered. However, the investment cannot exceed 10% of the unit capital of real estate investment trust and in infrastructure investment trust. Thus, the answer is C, 10%. Okay. Moving back to the next question, under Basel II, capital requirement under the accord is dash. Capital requirement. So, capital requirement is what? Under the accord is it the maximum capital that is required to be maintained, or the minimum capital that is required to be maintained, or the C option, the capital as specified by the regulatory authority is required to be maintained. D option is none of the above three. Now see here, the answer is C, the capital as specified by the regulatory authority is required to be maintained under Basel II guidelines capital requirement. So what is that? It's a 8%. Minimum capital of 8% of risk-weighted assets has been prescribed under Basel guidelines. However, the banking regulator in each country can specify their own appropriate minimum CRAR ratio, and naturally this has to be that is obviously this has to be adhered by all the banks operating within the jurisdiction of that country. So RBI here has prescribed CRAR as 9%. Moving back to the next question, that is how does the Basel III framework aim to strengthen the global capital framework? So how does the Basel III framework aim to strengthen the global capital framework? There are 4 options given. You can read one by one. See, the first option they have said is supplementing the risk-based capital requirement with leverage ratio. Second is raising the quality, consistency and transparency of the capital base. Third comes the introduction of a new liquidity measurements like liquidity coverage ratio LCR and net stable funding ratio. Fourth comes all of the above 3. Answer here is all of the above. D option. Why? Because see here the important implementation, the key implementation of Basel III includes the following, like stricter guidelines for qualifying as Tier 1 capital. Second comes the introduction of leverage ratio. Third is the liquidity coverage ratio and net stable funding ratio. And fourth comes CCB, that is nothing but capital conservation buffer. Introduction to capital conservation buffer requirements and counter-cyclical capital buffer CCCB buffer. Now question number 89. See here, look at the screen. There are 4 questions in this slide. We will see one by one. The first question here in this slide is, what is the minimum leverage ratio as per Basel III? Yes, look at the screen. I will move little fast. Look at the screen. and the options, the answers. I will only let you know what is the answer and what is the reason behind the answer. What is the minimum leverage ratio as per Basel III? There are 4 options given: 1%, 3%, 2% and 4%. Okay. So what is the minimum leverage ratio? Is 3%. Why? Because the Basel III has prescribed 3% as the minimum leverage ratio. However, RBI has prescribed the minimum leverage ratio as 4.5%. Okay. But here as per Basel III they have stated. So Basel III as per that 3%. 3%. Okay. Then moving back to the next question. What constitutes economic capital? What constitutes economic capital? Risk capital, cash flow, regulatory capital or none of these? Risk capital is the answer. Economic capital is mostly treated as synonymous with risk capital, is equal to risk capital. Why? Because it's the amount of capital estimated on the basis of risk. That's why risk profile of a bank. It's known as a risk profile of a bank. Then how many pillars are listed as per the Basel II capital adequacy accord? How many pillars are listed as per the Basel II capital adequacy accord? There are 3 pillars. See here 3 pillars. The 3 pillars under Basel Accord are capital adequacy requirements, supervisory review and evaluation process market discipline. Capital adequacy requirements are supervisory review and evaluation process market discipline. The last question in this slide, BIA under operational risk refers to BIA. We have already studied in our previous questions. You can go back to the first or the second part, you will get the answer. BIA is nothing but basic indicator approach. Basic indicator approach. Basic indicator approach, that is what? Banks in India are required to adopt one of the following approaches for calculation of their capital charges for operational risk. So this is one of the approach, basic indicator approach. Second is TSA, standardized approach. That is the standardized approach, TSA. See, that is the third one is AMA, advanced measurement approach. And incidentally, the AMA, that is the advanced measurement approach, is now been discarded and revised standardized approach, that is the RSA. Revised standardized approach has been proposed by the Basel Committee on Banking Supervision. Now, the question number 93, that is, see here, what should be the maximum amount of CCB, that is counter cyclical buffer as per Basel III. So what should be, I would repeat once again the question, what should be the maximum amount of counter cyclical buffer as per Basel III? There are 4 options given. It's is it 2.5%, 3.5%, 4.5% and 5.5%. Answer is 2.5%, A option. That is, see here, why? Because the maximum counter cyclical buffer CCB, the maximum counter cyclical buffer CCB, which is prescribed under Basel III guidelines, is 2.5% of the risk weighted assets. The CCB is to be maintained as CET1 capital. Now, next question, going concern concept. So, going concern concept, what is that? Is it a method of inventory valuation or statutes ensuring that the management changes are continuous, or it's an assumption that a company will continue in the business for the foreseeable future, or it's a status governing the procedures for management changes? So what is going concern? Going concern concept is nothing but C option, that is an assumption that a company will continue in a business for the foreseeable future. So going concern, what is that? Going concern takes a view that a company will continue its business for the foreseeable future. On the other hand, gone concern, it views the status of a company if it has to cease and wind up its business operations today. Okay. Then comes the next question. What is meant by rating migration? Rating migration. What is meant by rating migration? There are 4 options given, that is changing rating agency, Second is changing the rating model. Third comes changes in rating over a period that when rated on some same model. And the fourth option is changes in fee to rating agencies. Now, which option is it? What is meant by rating migration? Rating migration means itself, think in mind, changes in rating of a borrower over a time horizon when rated on a same model. So, same model. So, C option. Rating migration, it simply refers to the changes in the rating of the borrower over a time horizon when rated on the same model. Moving back to the last question in this slide, which one is the comparison of future cash inflows to its future cash outflows over a series of specific time period? So there are four options given. ALM, asset liquidity management, stress testing, maturity ladder, and the fourth option is back testing. Answer is C, maturity ladder. See why? Because the maturity ladder is a series of time buckets as per the example, as per the following example, like day 1, day 2 to 7 days, day 8 to 14 days, day 15 to 30 days, day 31 to 2 months, 2 months to 3 months, 3 to 6, 6 to 1 year, 1 year to 3 years, then 3 years to 5 years, like that over a 15 years. The inflow and outflow of funds are examined one by one and are placed in their respective time buckets Now, in this slide, see carefully the question. This is a practical question. A bank has the following position. Okay, a bank has the following position. See here which position. Tier 1 capital 500 crores. Tier 2 800 crores, right? Next is RWA, risk weighted assets for credit risk is 5000 crores. Capital charge for market risk 275 crores and capital charge for operational risk 180 crores. Then the CRAR, regulatory CRAR, they have specified is 9%. So see here, the question they have asked is, what are the RWA, risk weighted assets for operational risk? See, risk weighted assets for operational risk. Before seeing the answer, see here, capital charge for operational risk is 180 crores. 180 crores. Operational risk, they were mentioned in the question itself, it's given 180 crores. So 180 right there. Then regulatory CRAR, they have specified 9%, that's in India. Then RWA, that is the risk weighted assets, we need to find out. RWA is equal to the capital charge divided by CRAR. So capital charge is 180 divided by CRAR is 9%, that is 9 divided by 100, 0.09. 180 divided by 0.09. It will come 2000 crores. It will come 2000 crores. The next question in this slide, the last question in this slide is, bank has a paid up capital 100. Listen carefully, look at the question. Bank has a paid up capital 100, free reserves 300, then the provision and contingent reserves 200. Revaluation reserves, they are given 300. PNCP share is 400. Subordinate debt is 300. So what is the risk weighted assets for credit and operational risk? Both they have given is 10,000. And risk weighted assets for market risk 4,000. So based on the above given data, we need to find out the minimum capital to support credit as well as operational risk. So four options they have given us. Four options, see here, is the minimum capital to support credit and operational is 900, or the minimum capital to support credit and operational is 1111.11, or minimum capital to support credit and operational risk is 990, or the minimum capital to support credit as well as operational risk is 600. So the answer we will find out now. Minimum capital, okay, minimum capital to support credit and operational risk, okay, is risk weighted assets of credit and operational risk. So see here, what is the risk weighted assets for credit and operational risk? So they have given here 10,000. So 10,000 into, that is multiplied by the CRAR. CRAR 9%. CRAR is 9%. So see here, 9% will come at 0.09. So 10,000 10,000 multiplied by 0.09, it will come as 900. It will come as 900. So the answer is A option. Minimum capital to support credit and operational risk is 900. Now see here, this is our last slide for this video. Now see, this is our question number 99. Read the question and listen carefully. Which process is assessing their capital adequacy based on their risk profiles as well as strategies for maintaining their capital levels? Which process? They are asking us the process. Which process is assessing their capital adequacy based on their risk profiles as well as strategies for maintaining their capital levels? There are 4 options. ALM process. Second is ICAAP, Internal Capital Adequacy Assessment Process. Third is Internal Capital Audit Process, and fourth is none of the above 3. Answer here is second option. Second, that is the B, Internal Capital Adequacy Assessment Process. Internal Capital IC. Adequacy Assessment Process. AAP. So, Internal Capital Adequacy Assessment Process. What is this? This is a process for assessing the capital adequacy based on the risk profiles as well as strategies for maintaining their capital levels by the bank. Now, we will see here this question. The next question. A bank, this is also a practical question. Listen carefully, understand. A bank has the following position. Okay, a bank has having the following position. See here, it's mentioned Tier 1 capital 500 crores, Tier 2 800 crores, risk weighted assets for credit risk 5000 crores, capital charge for market risk 275 crores, capital charge for operational risk is 180 crores, regulatory CRAR is 9%. For India, 9% for India in this country. It will differ from country to country. What are the risk weighted assets for market risk? 4 options they have given us. So we need to find out the RWA for market risk. So see here, before looking the answer, just see how to solve. Capital charge for market risk. Capital charge for market risk, they have mentioned is how much? 275, right? So 275 crores. So as per that, CRAR ratio is 9%. Capital charge is multiplied by 100 divided by 9. Capital charge, listen carefully, capital charge is multiplied by 100 divided by 9, or you can say 11.11% to get the risk weighted assets for market risk. Okay. So now see here, risk weighted assets for market risk is equal to, take that answer, 11.11. 275 is the capital charge for market risk, right? Capital charge for market risk. Take that answer in the numerator, multiplied by 11 decimal 11. Multiplied by 11 decimal 11. So see here, in the numerator it will be 275. Then comes numerator, then comes the multiplied by 11.11, which will come into, no sorry, not the numerator. You will write directly the answer. 275 is the capital charge for market risk, multiplied by the answer which we received now, 11.11. So answer will be rupees 3055 decimal 25 crores. 3055 decimal 25 crores. So the answer is C, 3055 decimal 25 crores is the answer. So till now here we have completed 100 questions of CAIIB risk management frequently asked questions, which is very important before you attempt your upcoming exam. More 50 questions, more 50 plus questions are there, which we will be uploading one by one.